My name is Kate, and I have a W-2 job. I work in the medical device sector. I work for a startup currently in infection prevention, which is kind of an interesting time to be in infection prevention in the pandemic. I've been investing in syndications for about 4 years now, and investing in real estate for, about 15, 20 years. And I've done 5 deals with Ashcroft. 2 of them have gone full cycle, 3 are still ongoing. And I've done 21 syndications in total. I had done single family unit homes. I'd done a couple of small little multis myself, just like a 4 unit, a couple of 2 units. I then quickly sold those because they were just a paperwork headache. And I was really looking to transition from assets to cash flow. And most of the reason for that was because, I do have a W-2 job and I have an 8-year-old. And when you go to the grocery store, they don't really care what your asset value on a spreadsheet is. They care if you have cash to pay for your groceries. So I had transitioned from my priority being sort of acquisition of assets and, growing my sort of personal wealth for financial security, to really wanting to have cash flow, so that I have security in cash flow to be able to replace my income. So that's my goal. And so once I had clarity on my goal, my current strategy with some single family homes in California was not aligned with that. So I looked for other ways to transition and to get better return on my capital. And so that's really what led me to syndications and multifamily. And then, of course, along with that, because, I have a job that I like, which is great. And I'm a mum. So I needed something that wasn't going to suck up enormous amounts of time. So that's really what took me there. I'm familiar with residential real estate. Everybody needs somewhere to live. So it's certainly within my comfort zone. So that's really what led me to multifamily and to syndications. And I've since, within the syndications, I have, sorry, that noise is my dog in the background. I have since done syndications in the mobile home park space, self-storage, some industrial. And so it's really awesome to be able to have some diversification still within that syndication model. I can't remember exactly where I heard about Ashcroft first. I'm sure, I listened to Joe's podcast, so I'm sure it's from the podcast, Bigger Pockets, through those vehicles. And then I like to follow sponsors for about a year before I invest with them. So I listened to the podcast. I looked at a number of different deals just to get comfortable with the business model. I had a couple of calls with Joe to kind of understand it. I read his book. So I just got familiar with the company, got comfortable with them. The things that I look for in companies from an investment perspective is what's their culture, because I really believe strongly in the culture of the company is really, really important. And when things get difficult, which there are challenging times at any company, including a real estate company and a syndication model, their culture is what allows them to stick it out and to stick through difficult times, and to find a solution and to find a way. And so the culture of the company tells me that. It tells me that, are you going to work really hard when things get difficult? And I work really hard for my money. And I don't have lots and lots of it to spare. So I need to make sure that I'm trusting it with somebody who respects the work that I put in, and that it's security for my family. And that's why I sort of felt that Ashcroft were a really good company to invest with it. And they really were. They have been. They were a great introduction to syndications. And there's many syndicators out there. There's lots of different options to choose from. And when I look back now, I'm invested with, I think, 8 or 9 different general partners. And I still feel that Ashcroft was a really good place for me to start that journey. I didn't have any major objections investing with them particularly. It was really, for me, it was understanding that space and getting comfortable with giving control to someone else. You're giving your money to someone else and hoping that you get those returns. And so that it was really, for me, it was more of a comfort level in shifting that strategy. I've had a really positive experience. For me, it was, they were the very first syndications that I did. It's always very nerve-wracking when you start with a new sponsor. Certainly my first syndication, I had done quite a lot of reading. I'd listened to the podcast. I was pretty familiar with them. I was not new to investing in real estate, but I had always been an active investor. So sending a check to someone that you've had some conversations with, and then it sort of disappearing, and then you're anxiously awaiting to see if when you get the first payments, and is this real, etc. So it all really went as planned, as it should have done. It's always reassuring to get that first check and to know that it really goes well. And so, after the first one, I let that run for a few months, and then I, started investing in some more, and then branched out to some other syndicators for some diversification, some different segments too. So I found Ashcroft a really good company to start investing with. My experience was I was able to ask the stupid questions, which I needed to do. I still probably ask some stupid questions. And they're, very sort of gracious in answering those, taking time to explain the business model, any of the details that I'd asked for. And then the communication's really good. And I think that's really important, especially when you're doing your very first one. As I say, you send a check or wire some money, and then you're anxiously awaiting sort of what happens. Now, once you've done a few, you understand how they work, and it's a much more comfortable process. But certainly to start off investing, having a company that's very on top of communication, and have the resources and the people to actually answer questions and walk you through it was a really, really positive experience. The two deals that I have done that have gone full cycle, they've both been around a 20% cash on cash return and IRR. So they were relatively close to the business plan. They sort of went as they should have done. Having done this now for longer with more syndicators, the thing that I look for and that I value is people need to have enough experience that when things go wrong, they have the team and the experience, firstly, to mitigate as much risk as you can so things are less likely to go wrong. But secondly, when you're doing this number of deals, syndications, when you're dealing with large buildings, things will go wrong. That is inevitable. And having a really experienced team who know how to address those issues so they don't escalate. And then when problems do come up, communicating very clearly on them, and then having the experience and enough reserves and deep enough pockets to be able to make sure that the deal doesn't go south, that it can still be a profitable and a successful deal. So I feel pretty comfortable that Ashcroft do that they particularly now they've done so many of these. Their model almost seems the same. And a few friends of mine also invest with Ashcroft, and they say, but how do you decide between this deal or that one? Because they all look the same. And I'm like, well, they look the same for a reason, because the underwriting is so consistent. So I think that once it's a model that you get comfortable with, they look very similar, because I think the underwriting is very thorough. And I think that that's important. I think Ashcroft are a really good place to start with your syndication journey. If you've not invested in syndications before, the reporting's good, it's consistent, the communication's good. You can always get hold of people. I think that it is a really good place to start. I think the markets in which you operate, there's I think that there's good thought behind where you operate. Certainly most of the investments that I've done have been in Dallas, Fort Worth, and have been in Florida. And I feel like bringing property management in-house, I think, is a really, for me, that's a really positive thing. These are operational businesses and they need to be operationally strong. And I think that strengthens Ashcroft's position and ability to continue to evolve as the market space changes. And I think over the next few years, at some point, it's been asset prices have continued to increase. It's, the last few years have been, I'm sure, of course, challenging with COVID, but asset prices have increased, rents have increased. There'll be some challenging times ahead. That's not going to last forever. And so I think having an operator where they're operationally strong within their business and thoughtful about where they invest, I think is going to be really important moving forward. The biggest result I've achieved is I sleep well at night. And when it comes to tax return time, I'm not having to spend a lot of time pulling together receipts and making sure I'm kind of on top of everything, as was the case with single family. So having a K1 that I send to my accountant, honestly, is the biggest result and a delight. I have a busy job. I'm the mum of an 8-year-old. Life is really busy. So for me, the big thing is getting reasonable returns, but not having any of the headaches. Quite frankly, that's really important to me. The preferred return on the deals that I've been in is I think it's 7 or 8% in the deals that I'm in. The monthly cash has been what it was predicted. Managing, of course, through COVID. Was going to be interesting, and the team really have done that incredibly well. I'm sure there were enormous challenges, and I think the Ashcroft team did manage those, and the returns continued to come, which was surprising and fantastic, quite frankly, from my perspective. But ultimately, going through 2 deals full cycle with cash on cash returns, both the cash on cash and the IRR were both, around 20% when you average out over the deals. It is great. And being able to do that, as I say, passively and just being able to forward K1s is quite a delight. The passive losses for me are important too, especially coming out of single family and into syndications. There's capital gains that I'm liable for. And I was the first tax return that I did, my capital gains tax bill was significantly lower than I was expecting it to be, because the passive losses that offset it from syndications were really impressive. And so my concern coming out of my reticence to come out of single family was that it was going to be a bit painful from a capital gains tax perspective, but actually it's been much less painful than I anticipated. Some of that maybe, I'm not quite sure about tax law, and I'm in California, and capital gains is, I think, treated as income or something. So there may be, I am no CPA, so but that was incredibly helpful. I'm still in 3 current deals. The returns are consistent. I think the business plans are solid. I think the markets that they function are good. I like they're looking at some markets out in, Phoenix, for example, further west. I think that's good. So I think, I've had a really positive experience, and when you have a positive experience, that's a good reason to continue to invest. One thing that was really helpful for me was I had 1 or 2 deals within my IRA that had gone full cycle, and I had made a mistake on money going into the wrong account, which can have huge tax consequences. And I called Joe, and literally within like a day, it was sorted out. And my IRA, self-directed IRA custodian was not very helpful. And Ashcroft really, really were. And it was not a big deal. We were able to kind of move it back, correct it. Like it was really, I was really, really pleased with how helpful the team were. And it wasn't their mistake, it was mine. And they really helped me to sort of unravel it very quickly. So I was really grateful for that.